Paying taxes on a fixed income is suffocating. With historically high inflation and meager Social Security income, many older adults have to scrap for every single dollar in retirement. What if I told you there are legal ways to reduce or even avoid paying taxes altogether? Stick around because in this video, I'm going to share 4 smart strategies that seniors can use to minimize their tax burden legally. And trust me, you don't want to miss strategy number 4. It's a game changer that many people overlook. Now, before we get started, I am not a tax professional or an estate planning attorney. The information I share is for educational purposes only and should not be considered professional, financial, or legal advice. I always recommend consulting with a qualified financial advisor or attorney to address your specific situation. First up, let's talk about Roth conversions. If you're nearing or already in retirement, the idea of paying taxes on your IRA withdrawals can feel like a dark cloud hanging over your head. But here's the thing. You can avoid future taxes by converting your traditional IRA or 401k into a Roth IRA. Yes, you will pay taxes on the amount you convert now, but here's the kicker. After that, your money grows tax-free, and withdrawals in retirement are completely tax-free too. Now here is how a Roth conversion can change everything for Susan and Mark. While their taxable income's relatively low in the first few years of retirement, they decide to convert $100,000 of their IRA to a Roth IRA. Now they will pay taxes on that $100,000 this year, about $22,000 at a 22% tax rate, but here's the key. After that, the money in the Roth IRA grows completely tax-free. Now, when they withdraw in the future, they won't owe a single penny in taxes, either on the original $100,000 or on the growth. So let's assume for a minute that the $100,000 grows to $250,000 over the next 15 years. Because they used a Roth, they avoid paying taxes on the entirety of that $150,000 in growth. That's a massive savings. Now, why does this matter? Because in retirement, every dollar saved counts. By paying taxes now while rates are historically low, you're essentially buying yourself tax-free income later. And that all sounds great, but that's all for the future. Let's talk about a strategy to help you save money on taxes right now, today. Strategy number 2 is all about maximizing your standard deduction and tax credits. If you're 65 or older, you are eligible for a higher standard deduction, up to $15,700 for single filers and $27,700 for married filers in 2024. That's an additional $1,850 for single filers and $3,000 for couples filing jointly. But you must make sure you file correctly and you meet all the requirements. So now is the time to ask your CPA to help you make sure that you take advantage of the increased deductions. But wait, there's more. Adults age 65 plus can qualify for an additional senior citizens tax credit that can reduce your tax bill significantly if your income meets the threshold. This tax credit, which reduces your tax liability dollar for dollar, is $5,000 for single filers and $7,500 for married filing joint in 2024. That can easily reduce your tax liability to zero. A lot of seniors can and will meet this income threshold because so many rely on Social Security income and have large medical expenses. But here's the catch. Many people miss out on these benefits because they don't file correctly or they don't seek professional advice. To put yourself in the best position, keep detailed records of your income, deductions, and medical expenses. And of course, please consider working with a tax advisor who specializes in senior tax strategies. They can help you find deductions you didn't even know existed. Now we're just getting started. Strategy number 3 is perfect for those who want to stay charitable and keep Uncle Sam out of their pockets. Strategy number 3 is using qualified charitable distributions. Now here's something you may not know. Qualified charitable distributions, or QCDs, are one of the best kept secrets for reducing your tax bill in retirement. If you're over 70 and a half and you have a traditional IRA, you can donate up to $100,000 directly to a qualified charity. The best part, the amount you donate doesn't count as taxable income and it can satisfy your minimum distribution or your RMD. And why does that matter? Because RMDs are taxable and they can push you into a higher tax bracket if you're not careful. By using a QCD, you're not only supporting a cause you care about, but you're also keeping more money in your pocket. It's a win-win. Now, if you want to avoid taxes on your estate, number 4 is for you, and trust me, you'll want to hear this. Strategy number 4 is estate and trust planning. For retirees with larger estates and even those with fewer assets to protect, estate planning can be especially beneficial. So let's talk about estate planning with trusts. Now, with uncertainties looming about the federal exemption on estate tax, it's important that we plan for the worst case. And if you're worried about estate taxes, capital gains, or ensuring that your assets go to your loved ones without Uncle Sam taking a cut, a trust might be just the solution. For example, an irrevocable trust can remove assets from your taxable estate while still allowing you to control how they're distributed. Now, another option is a charitable remainder trust, which provides you with income during your lifetime and leaves the remainder to a charity, all tax-free. The cool part about this is the sale of appreciated assets by the trust doesn't even trigger capital gains, and to sweeten the deal, you receive a charitable deduction when you create the trust. Estate taxes can eat away at the legacy you've worked so hard to build, and without proper planning, your loved ones might face unnecessary stress and costs. But by working with an estate planning attorney, you can create a plan that ensures your assets are protected and your family is taken care of. Imagine the peace of mind that comes from knowing your money is safe from taxes and going exactly where you want it to. Doesn't that sound worth exploring? I promise that it is. All right, quick recap. Today we talked about Roth conversions for tax-free income, maximizing deductions and credits, using qualified charitable distributions to reduce taxable income, and estate and trust planning to avoid estate and capital gains taxes. These strategies aren't about dodging taxes, they're about keeping more of the money you've worked so hard to earn and using it to create a retirement that is stress-free and fulfilling as possible. Now, if you found this video helpful, please give it a thumbs up and share it with a friend who might need this information. And don't forget to subscribe for more tips on living your best life after 55. And hey, if you've got questions about taxes or retirement planning, drop them in the comments. I'd love to help you make the most of your golden years and to be a resource to you as you navigate retirement.